All right. Happy Wednesday, everyone. Thanks for joining me for hopefully a quick presentation on a somewhat could be complicated concept, but we're going to try and make it simple. And we're going to go through this fairly quickly and high level. My name is Tim Kraus. I've been in the life insurance business for about 15 years. I started in the field as an agent. And I've been with financial brokerage here for a little over 6 years now. This concept or this topic that I'm going to talk about today is one of the very first things that I learned about as a brand new agent, starting with a large career distribution a long time ago. One of the things that I want to focus on today is how to take this concept and make it simple and make it something that each client can understand in an easy way. So here's the high level what we're going to go over. Like I mentioned, I'm going to try and make this brief and quick. Each one of these topics that you see on the agenda that I have listed, hopefully you can see that there. We could take a deep dive and spend an hour on each one, and that's not my intention here today. I'd rather talk through these at a high level, give you an overview, and if there's something that we can follow up on, I'm happy to have an individual conversation to talk more about each one of these in particular, and hopefully as we go through this, you'll think of clients that you might be able to talk to about this, that this might be right for, and as you want to prepare for that presentation or for that conversation with that client, I'm certainly willing to help you out one-on-one with that. So starting off, we're talking about tax-free retirement income using life insurance, but we're going to focus on the tax-free retirement income part because that's essentially what we're doing. Life insurance is a wonderful product and can be used for many different things. Today, we're specifically focusing on one aspect, and that's tax-free retirement income. So why is that important to people? Obviously, I like to point this out to people. Some people are aware this exists, some people aren't. There's a website called usdebtclock.org where you can get a real-time calculator on what our current national debt is, that debt per taxpayer number, what the deficit is, how the government spends our money, what money is coming in. Lots of detail here. I'm not going to go through this. You can spend as much time as you want on that. The point of putting this out there is to simply say, if you look at the government's balance sheet, for lack of a better word, we have a large deficit. We have a growing federal debt that each one of us are responsible for, whether we like it or not. And I'm not a political expert. I'm not an economic expert. But what I do know is it seems likely in our lifetime that each one of us is going to have to do something about that. And likely that's going to be increasing taxes in one form or fashion. And so the question becomes, do you believe that tax rates, specifically income tax rates, might increase in the future? And how you fall on that spectrum determines whether or not you might be a good fit for the concept that we're talking about. Personally, I wouldn't be talking about this concept unless I believed that it's much better to put as much money in tax-free buckets that you can have so that you know and you have control over your retirement income situation, and you're not going to be derailed by increasing tax rates to whatever they might be in the future. So, and here's the deal. Where's the money now for most people reaching retirement? You have different buckets, the taxable buckets, equities, bonds, mutual funds. I put Social Security with a question mark on there because if somebody doesn't set up their retirement the right way necessarily, that Social Security income can become taxable. So that might be part of the taxable bucket. The tax deferred bucket, your typical qualified retirement plans, things that people might be contributing to through at work, or maybe they have an IRA that they've set up on their own. And then you have the tax-free bucket, which is, Roth IRAs, Roth 401ks, which are becoming more and more popular. Some people might have started to convert their 401k or IRA over into a Roth, and then life insurance, which is what we're going to talk about today. So most people reaching retirement now, where does a lot of that money exist? It's in this tax deferred bucket, because these things like Roth IRAs, Roth 401ks didn't always exist or weren't as popular as people started contributing to their retirement plans. They might not have had those options through their employer in the past. And so a lot of people have money, or at least a significant portion of their money in those tax deferred buckets. So what does that mean for the future? Obviously, it just means that we have to be cognizant of where we're going to contribute additional money to in the future. So if we're going to talk about life insurance, who might be a good fit for this concept? This is probably the most important slide in the entire presentation, because I talk about this, I've talked about it for 15 years, and where people tend to go wrong is they see what life insurance can do. They believe in, the importance of the tax-free retirement income, and they want to take this concept and apply it to everybody they meet with. And unfortunately, this is just not the best starting place for people. So if you have somebody that is not currently contributing to any retirement plan, I would say life insurance is probably not the best place to start. If you have someone who is barely getting by, living paycheck to paycheck, and maybe they're contributing 3%, 4%, 5% of their income to their retirement plan, and their employer is matching that, I would not suggest adding life insurance on top of that, or I would not suggest replacing their existing retirement savings plan with life insurance. It's not a one-stop shop. People should continue to contribute to multiple buckets. If they can qualify for a Roth IRA has is a different product than life insurance, and it should be a part of somebody's retirement savings plan. So we're looking for people that earn a significant amount of income, or I don't know if significant is the right word, but people that earn a good living and maybe what's less relative, right? Because high income can mean different things to different people. What they have is disposable income, and they're not living paycheck to paycheck. They have plenty of room in between their expenses that they have to meet and the income that's coming in. And that income is expected to be stable into the future with their career. Because once we start this plan, we don't want to stop it, right? This is something that we want to put in place and have steady contributions, and I'll go over that in more detail as we talk about the actual construction of the plan. But having that, we don't want this to be a strain for people where we're dragging $300 a month out of somebody's budget or dragging $500 a month, and it's putting a strain on their finances. Because if you start this for somebody and they're not able to continue with it, you've really done them a disservice, because all they've gotten for that period of time is much more expensive life insurance than they actually needed. And if they're not able to continue contributing to the life insurance policy and paying those premiums, the retirement income portion of it will never come to fruition. So very important that we're finding people that can not only afford this right now, but afford this well into the future, okay? I put youngish on here. Again, this is a little bit relative. I would say the younger, the better. But also, the younger you are, probably the less disposable income that you have. And you aren't always able to anticipate what's going to happen with your expenses in the future. But The bottom line is ideally we're 20 years away from retirement. So a 45-year-old getting ready, planning to retire at 65 years old of age, great fit. I would say there's certain carriers and products that can work for people into their 50s if they're not planning on retiring in the next 5 to 10 years or don't need the money for 15 years. A 55-year-old, maybe starting the income at 70, it's possible. It's not our ideal fit for this. I'd say 45 years of age and younger. And like I kind of mentioned, people that are already saving money for retirement. This is not your end all be all retirement plan. We want this to complement somebody's overall retirement plan, whether that's their taxable buckets, their tax deferred buckets, and other money. Hopefully, they qualify for in tax free buckets like a Roth IRA, or they're working on converting some of their 401k IRA money over into that Roth space to prepare for that tax free retirement income. So, if we find somebody that's a good fit, then we got to figure out which product do we want to use. Today, I'm going to talk about Index Universal Life. I think when you find a good carrier and good product with Index Universal Life, that gives you the best combination of safety of principles with that 0% floor, but some upside potential, especially today as we see interest rates go up. We're going to see cap rates continue to go up, and it gives us that upside potential. Still a conservative product. I never talk about Index Universal Life talking about upside first. This is something that you would hope to average 5 to 6% over a long period of time. This isn't something where you're going to try and get the highest return out of everything in your investment portfolio. This is the safety portion of your principal, the safe money. So, Index Universal Life, other life insurance products are okay. They fit this concept. It's a matter of what you and the client is most comfortable with. This can work with a good whole life product. This can work with variable universal life products, not nearly as safe, but it can work. We don't work with variable universal life at financial brokerage. And this can work with fixed universal life type products that offer a specific interest rate year in and year out. That's how I first learned this concept. So if we're choosing an Index Universal Life product, what are some of the things that we want to look for? The first thing is guaranteed loan provisions. And the reason why that's important, I'll talk about the design of the product and the presentation of the product, but we want to know that when we get the money out, we're going to be able to take advantage of some of the special features of life insurance, and we have some guarantee as to how we're going to be able to get that money out of the contract. So I'll go over that in more detail later on. If there is a bonus on the product, I don't necessarily think that you have to have a IUL that has a bonus. I think there's some out there that don't have any bonus features that are perfectly fine. But if there's going to be a bonus illustrated, I want to make sure that that's guaranteed in the future. I would say stability with cap rates is probably the number one thing that you're putting your faith in when you're choosing an Index Universal Life product. You have to have some level of faith that the company that you choose is going to keep that cap in a place that's going to give you a decent enough return in order to make this concept work over the long run. And so when you're choosing a company, there's companies that have history with that in a positive way, and there's companies that have history of that in a not so positive way. And so, we know which carriers those are. We can help you choose the right carrier from that perspective. Same thing with low fees. Typically, your more financially stable carriers that have stability with their caps and have guarantees within their policy instead of bells and whistles that might not be in there. in the future, typically come with lower fees as well. So we'll talk about, this isn't necessarily a carrier highlight type webinar. We're really just going over the concept. For the concept that I'm using today, I've taken some screenshots of an illustration. I'm using Columbus Life with those screenshots. Some other carriers that we might recommend from time to time would be a North American, a Mutual of Omaha, an Emeritus. And there's positive and negatives with all those carriers, but they all have some of those main features that I just talked about. And so we've got multiple carriers that we like. That's just to name a few. There's other ones that we could use besides those as well. And then there's ones that we tend to shy away from. I'm not going to mention those on the webinar, but they don't necessarily fit into some of those things that we look for in making a recommendation. So how do we design these policies? I mentioned it a few times, but they're best designed with consistent ongoing premium. This is something that you can afford to pay on a monthly basis or an annual basis from today into 20, 25, 30 years into the future. You know, we get short pay scenarios, those can work as well. Single premiums, typically not a great fit for this concept. What happens with single premiums with short pays is that you're going to end up driving the face amount higher, which gets into my next point, is you want the lowest face amount possible for this concept to keep the expenses, specifically cost of insurance, as low as you possibly can keep that. So it'll make a little bit more sense as I talk about it. The increasing death benefit switching to level, I have an asterisk on this. This is typically how we've always designed these, and I still think it's the best way. Outside of one caveat, there are carriers that work well with what's called an option 3 or a return of premium death benefit option. And instead of having the lowest face amount possible and increasing by the amount of the cash value increase each year, a return of death benefit face amount option will start a little bit higher, and it's going to increase by the amount of premium paid each year into the policy. So it's a unique option, and it does actually work well with certain carriers that have that feature available. So that's an asterisk there. And as we get into designing these policies and presenting them to clients, we can look at those. And then we're going to design this for a certain age and certain time period to maximize the amount of loans that we can take out of the policy. So I did forget to mention at the beginning of the call, I am monitoring the question box. So as I'm going through this, if questions come up, throw those in there. I'll be able to see those and answer them as they come up. But as I mentioned, I've got some specific examples to talk about with the sample policy design here. This is from Columbus Life. I've picked out a couple pages of the illustration that I think are important to point out. And this is exactly what I would talk to my clients about. So this is more for you guys to see what I've done. This is a 45-year-old preferred individual. I decided $10,000 a year in premium. And that is, you know, so when I say $10,000 a year in premium, that is a good, maybe average type policy that we're looking at with this concept. If you're looking at somebody that can pay $100 a month at age 45 years old, this might not be the best place for them, right? $500 a month, much better, probably can make something work. You know, when you get into closer to $1,000 a month or $10,000 a year, that's a good sweet spot, I think, that's where you're going to get enough accumulation and enough premium into that policy to generate a significant difference-making income for their retirement. And obviously, for those individuals that might be ultra-high net worth or ultra-high earners that can afford much more than $10,000, this is a great concept for them as well. So What I did was put the premium in. I said I wanted to pay $10,000. Give me the lowest death benefit that I can have for that amount. That comes out to $154,134, and that is an increasing death benefit with this policy. That's the only thing I'll talk about here, other than to mention living benefits. I think living benefits is a good or a significant buzz in the life insurance industry right now, and for very good reason. It's a great feature for life insurance policies. And you'll even see people that when they're saying, if you're taking out a life insurance policy for retirement income, you really got to look at the living benefits and make sure you get good living benefits. I don't personally believe in that quite as much, not because I don't believe in the living benefits, but the purpose that we're taking this policy out for is to accumulate cash value into the policy to take out for tax-free retirement income. While I'm doing that, taking that money out and getting as much money out of it as possible, I'm going to significantly reduce that death benefit, which is going to significantly reduce the living benefits available. So I still love using life insurance for the living benefits aspect. My recommendation would be to use a separate policy for that, where you're going to have a higher face amount and keep that face amount higher out to age 85-ish, where somebody might need to access those living benefits. So my 2 cents on the living benefits aspect, I will say most of the carriers that we recommend have great living benefits anyways. So if you disagree with me, you'll still probably end up agreeing with me on a carrier to use. I put this snapshot of the illustration in just as kind of a reminder to talk about this. The first thing that clients have to understand about potentially purchasing an index universal life policy for accumulation is how that money actually accumulates. And when we talk about things like the S&P 500 or other indexes within the policy, sometimes clients can grow weary or think, well, so you're just putting my money's just going into the stock market. And that's obviously, we know, not true at all. And we need to have a very good, succinct explanation of how interest gets credited to the policy and where the client's money actually goes when they pay that money to the insurance company. So no need to go into any more detail than is necessary for the client to understand what they're getting. Unless they ask questions, obviously you need to know the answers to those questions. But a very good, simple explanation is to let them know up front, Mr. or Mrs. Client, even though we use terms like S&P 500, none of your money is actually getting invested into the stock market. The insurance company with an index universal life policy uses that as a benchmark to know how much interest to credit your policy on a year in and year out basis. With an index universal policy, it works as simple as this. You have a floor and a cap. That floor is the least amount that you'll get on an annual basis, and that cap is the most amount on an annual basis. So when you're presenting the policy, you'll let them know. The floor for this one is 0%. So no matter what happens, you will never go backwards in this policy. 0% is the least amount you can get. When you're presenting the policy, you'll know the cap of the S&P 500 of what you're presenting. You'll say maybe it's 10.5%. On any given year, the most you can get is 10.5%. So depending on how this index performs independently of the insurance company, that's going to indicate how much interest is credited on an annual basis. The least amount you could get is 0%. The most you could get is 10.5%. Historically, with this floor and this cap, that's averaged somewhere around 6%. Good. So no need to really make it any more complicated than that, but they do have to understand where their money is going and how that actually works for the policy. So next thing to point out to them on a policy, index universal life policy, is how are we able to generate income out of this policy more efficiently than other types of vehicles? Well, the main way is through participating index loans. And when I go back to that previous slide, I said we need guaranteed loan provisions to make us feel comfortable that we're going to be able to get the amount of money out of the policy that we should be able to. Is we want to know what the current participating index loan rate is and what's that guaranteed maximum. So some carriers will have what I would say would be very fair current interest rates on their participating loans, but either no cap on what they can increase that to or a very high cap on what they can increase that to. With Columbus Life, one of the reasons why we like them as a carrier, their participating loans are currently at 5% interest, and the guaranteed maximum is 6%. Okay, so that 6% guaranteed maximum is very fair, very competitive. So, explaining a participating loan to a client. Mr. or Mrs. Client, when you go to take money out of this policy, we're going to take loans out of the policy. That's how we generate the money out of the policy tax-free. When you take a loan out, the insurance company is going to charge you interest on that loan, but they're also at the same time going to leave that money in the account value to have interest credited back. There's two types of loans. There's a standard loan in which the insurance company will charge you interest and credit you interest at the same exact rate so that it comes out to a 0% rate on that loan. There's also participating loans, which I recommend to get the most amount of money over the long haul. What that means is the insurance company is going to charge you an interest rate on the loan coming out, but that money is still going to participate in the index like the rest of your account value. So if in a given year the index returns 10.5% and the insurance company is charging 5% interest, you still have a 5.5% positive credit on that money that's actually been taken out and you've received in the policy. This is going to allow us to take much more money out of the policy than we put in. Sound fair? Sound fair. Now, obviously, there could be questions on that. The more that you get that short conversation down to both highlight, how unique that provision is and how it works to their advantage, but also at the same time keeping it simple and not overcomplicating it, is going to be one of the keys to being able to sell this concept on a consistent basis. It's one of the power features, one of the things that people really stand out and say, okay, if so-and-so has told me not to use life insurance, but I can only get this particular aspect from a life insurance policy, maybe so-and-so is not right, and maybe I really should look at this because this is really unique and a positive feature. So last few slides here that I have. When I run these illustrations, I specifically choose to include the ledger concept. When you get the full illustration, and maybe you've seen these, maybe you haven't seen these, there's 30, 40 pages, and in those 30, 40 pages with every illustration is probably 2 and 3 pages of a ledger, and it's going to have the guaranteed, the midpoint, the non-guaranteed, numbers from left to right, and it can be quite overwhelming to look at. Not to say that this isn't by itself, but if you choose the ledger concept, this is going to print out as a supplemental report at the end of the illustration, and it cleans and streamlines the actual ledger, and it's going to use the non-guaranteed numbers, the non-guaranteed ledger, so that it's much more easy to look at and read off and point out some things to the client. Now, you all know, and we know, and your clients should know, because you should tell them, the illustrations are non-guaranteed, okay? So the only thing that's really guaranteed about illustration is probably not going to come out to be these exact numbers. But what we have with an illustration is to see, based on the elements of the policy that the company controls, right? The cost of insurance, the policy loads, and the elements that we're inputting into the policy, the premium, the face amount, the age of the client, the things of that nature. If you take those and use an average interest rate based on historical returns, this is how the policy would come out. So it is reasonable to expect, based on our inputs, that the numbers will come out looking somewhere in this ballpark. Okay, so here's our numbers, right? I put $10,000 a year for a 45-year-old going out to a retirement age of 65, $10,000 a year for 20 years, $200,000 total in premium. By the time that I get to age 65, I've got roughly $350,000 of cash value and a $500,000 death benefit. A couple things that I would point out to the client so they understand how this works. If you look at year one, I pay $10,000 into the policy and my cash value is only $4,700. What happened to my other $5,300? Right? So important for them to understand, if you want to pay $10,000 into a vehicle, get interest on it and take that money out right away, life insurance is not the best place to put that money. Life insurance is very expensive up front with charges, so that it can be not expensive on the back end when we need it to, which is when we're going to take money out of the policy. So point out, in those early years, you're putting a lot of money in, there's not a lot of surrender value within the policy. So if you're not going to be able to contribute this $10,000 a year going forward, if you think it's something you might only be able to do for a year or two, don't start. You're going to take a loss on this. Where you start to see a gain, you can point out a couple of things. By year three, we are already having a higher cash value increase than the premium that we put in. $10,330 increase, $10,000 of net annual outlay. I think year 8 on this policy is where we've got $80,000 that we've put in total, and our cash value is $85,993. So that's kind of our break-even point. Worst case scenario, Mr. or Mrs. Client, 8 years into the policy, you decide it's not for you anymore. You should still be able to walk away with around the same amount of cash value that you put into the policy, so you haven't lost any money other than the opportunity cost. So those are the things to point out early on, right? When we get to age 65, we put $200,000 in, we have $350,000 of cash value, $500,000 of death benefit. Sounds good, except that is really not even half the story. That's maybe a quarter of the story of what we're actually going to accomplish with this policy. When I get to that age, I'm going to start taking money out, and I've solved for the maximum amount that I can withdraw over the course of 30 years. Side note for you, when you're designing these, you can design that income to go to 100, you can design it to go to longer, you can design it to be shorter for 20 years, whatever it might be. That's going to change the amount. I like to use 30 years as an average, very conservative amount of income that's going to get somebody well past what their retirement income needs would typically be, but many ways to design that. So that number comes out to roughly $24,000 a year. And you can see, Mr. or Mrs. Client, that when I take that money out, my cash value has only decreased by $3,000. How is that possible? Because of what I explained in those loan features. When we're taking the money out, that money is still being credited interest on the back end. So I'm taking money out, but it's not significantly reducing my cash value the way that taking money out of a different type of investment would be. So as we go along, get back on the right mode here so I can get to the next screen. Now I've done it. All right. Okay. Hopefully you guys can still see my screen. I've messed with that a little bit. So if I get out to age 95, you can see that I've taken $24,000 a year out for 20 years. I still have some surrender value left. I still have a death benefit left. So if you see on the net annual outlay that number negative 524, 560, does that mean I've taken up a total of $524,000? No, that's actually not correct, because you have to take this amount and go back to what we had as far as total premium outlay of $200,000. So the total amount, if you take 24,152 times 30, it's actually $724,560. So these are the numbers to talk about with the client. Mr. or Mrs. Client, this illustration is showing that if you pay $200,000 into the policy, that can actually generate $724,560 of retirement income for you, tax-free. Or, put it more simply, if you pay $10,000 a year for 20 years, you can take out $24,152 a year for 30 years tax-free. Sound good? Great. All right, I got a note that the slide's not showing. Let me see here. All right, hopefully that's showing now. So this number was what I was pointing out. The 524, 560 is going to show the total amount over and above the $200,000 that you put in, taken out. So that's really the full story. Like I said, a lot of these things we could go into more detail on as you're getting ready to present this to a client. I wanted to give you the roughly, I guess, 30-minute overview going through this concept. There's variations to this. There's unique situations for each and every client that you might come across, but the main principles stay the same. You know, we're looking for high income earners that have the disposable income, that need to create additional tax-free retirement income. And we use the powerful features of Index Universal Life to accomplish that, with the participating loans, the indexing feature, and just the general taxation provisions. That's the meat and bones. Again, you're going to have clients that want to know details on this inside and out, and we can prepare for those. You're going to have clients that have read all kinds of nasty things online, or heard things on YouTube or whatever it might be about why they should never do this, or the insurance companies are a scam, these illustrations are a scam. And in some cases, that can actually be true. That's why we need to choose the right companies and understand what they're actually putting into these illustrations. But there's all kinds of objections that you might come across with this. That's a whole nother probably 30 minutes of conversation or more. And I'll look for an invitation. I'll put together something just to go over all these objections that you might hear on the back end. But as you're preparing to meet with a client, certainly give me a call. We can start to talk about some of those. Some are founded in reality. Some are just completely off base and things that people make up because they want to sell things other than life insurance. And some are, like I said, they're real things that if you're choosing the wrong products, choosing the wrong companies, designing these the wrong way, or selling them the wrong way, then some of those objections do actually become reality. And so those are good to be aware of as well. But if you're choosing the right company, you're designing this the right way, and you're explaining it the right way to the right people, this is a very safe concept to present to people, and it's something that you can have confidence in. And it's something that provides a tremendous amount of value. And as people see the value in this, not only are they going to stick with it, but they're also going to tell other people that they know. Because what I've found is people that earn a high income and save money for retirement typically are around other people that earn a high income and save money for retirement. That might be good to work with as well. So I'll end it with that. I'll pause just to see if any questions come in before ending the webinar. I'm going to go back, if I can, to the very first screen. That's my contact information at the bottom. Please always feel free to give me a call. That's my direct number. Give me a call to go over this in more detail, or shoot me an email. Would be happy to talk about a particular client or case. And will I be sending out the slide deck? Absolutely, I can say that. Question on making an initial dump into the cash value, let's say 100,000. The short answer is yes, with the caveat that I kind of talked about on one of the slides is it's kind of a more unique situation. You can make it work. I would say that we don't want to do anything that's going to drive the face amount higher than we need it to be, because that's going to create additional expenses that are going to drag down the policy. Most companies have things called premium deposit accounts now, or they might have variations of what they call that, where they hold, let's say you want to do a $100,000 dump in, and they're going to hold that money at the insurance company, give the insured a credit, and they're going to release a certain amount of that premium over the course of maybe 5 to 10 years. That's going to allow that dump in to not drive that face amount too high for the expenses. So if you have that scenario, we could certainly try and design it to make it work. We just want to make sure we don't drive that face amount too high. Yep, I got a comment about the PDA. Yes, that would be probably the way to go on that. Term rider to avoid MEC. Yeah, possibly. But, in that case, you might just want a separate term insurance policy. But those are kind of those variations that, as we're designing those, we'd certainly figure out a way to make it work best for the client. I guess I should have started with the short answer is yes, we can make it work. Recording sent out. Yes, I'll send out the recording to you. Schedule for upcoming webinars. I'd like to say that we have all these planned out well in advance. We don't always. So no, not a schedule for upcoming webinars, but we do try and give advance notice. And either myself or Brian is usually going to be doing these about once a month or so, typically on Wednesdays at 11 o'clock. And we always send out multiple communications when we're having those. Cool. I think I got everybody's question answered. If I didn't, shoot me an email. I'll be sending the recording and the slides. Just don't send them to the clients with my name on it, because I have not run these by any compliance other than what I think is right, and that might not fit with what the marketing regulators think is right. So for your use only, feel free to review the slides and recording. So thanks, everybody. Apologize, I did go a little bit longer than I thought. Sometimes I guess once I get started, I have trouble landing the plane, but I'm going to do that now. Appreciate your time, and I'll be in touch with more information. Thanks.